Most people say they want to own a stock forever, but what they really mean is that they want a stock that goes up for a while and gives them the pleasant illusion that patience is easy. Forever is not easy. A business worthy of that word has to survive boredom, fashion, recessions, envy, overexpansion, technological change, new management trends, regulatory moods, and the very human habit of paying too much for whatever is currently exciting. When I have thought seriously about holding something for a very long time, I have never begun with the stock chart. I have begun with the nature of human behavior. I have begun with the question underneath the income statement. What will people still do 10 years from now, 20 years from now, 30 years from now, even after the headlines change, the tools change, and the language changes? That is the real question. A man who asks that question correctly will usually make fewer mistakes than the man who spends all day trying to guess the next quarter. The crowd often looks for forever in the wrong places. It looks for novelty, it looks for velocity. It looks for the most dramatic revenue line on the screen. But permanence very often hides inside repetition. People will still buy things. People will still borrow money. People will still communicate, compare status, admire brands, care about appearance, reach for stimulation, and pay too much for a premium experience that makes them feel important. If you start there, you do not begin with a list of tickers. You begin with the recurring habits of civilization. That is why the best long-term ideas are usually not the ones that require a heroic prediction. They are the ones that require a realistic understanding of how deeply a business has inserted itself into a durable pattern of life. When a company becomes the default choice inside a recurring human behavior, time starts working for you. That is what makes Amazon so difficult to dislodge. The simple explanation is that people buy things online, and they will keep buying things online. The more important explanation is that Amazon has turned convenience into a reflex. A person does not sit down and perform a grand strategic comparison every time a light bulb burns out. The dog needs food or a charger breaks. The person reaches for the phone, types a search, expects a fair price, expects broad selection, expects quick fulfillment, and expects the process to be almost frictionless. Once a company becomes associated with that reflex, it is no longer merely participating in commerce. It is shaping the route by which commerce happens. That is a powerful place to stand. The remarkable thing about Amazon is that one habit supports several businesses at once. The shopper arrives for the product, which strengthens the retail machine. The merchant arrives because the shopper is already there. The advertiser arrives because the shopper is already in a buying mood. The enterprise customer arrives because the company built enormous computing capability to run its own operations and then turned that capability into a service the rest of the world could rent. The same organism keeps growing new economic organs. That is not accidental. That is what happens when scale becomes an engine for adjacency. Many people make the mistake of viewing Amazon as a business that spends too much money for too long. I have seen that kind of complaint many times in my life, and sometimes it is correct. But there is an important distinction between waste and deliberate capacity building. Some businesses spend because management lacks discipline. Other businesses spend because management sees a larger runway than the market is willing to imagine when a company has a record of building distribution, warehousing, logistics, cloud infrastructure, and then using those assets to create future earnings power. I pay more attention to what those expenditures are intended to become than to the temporary discomfort they create in current free cash flow. A great many fortunes are missed because investors insist on being paid immediately for progress that is still under construction. What I find durable in Amazon is not one segment by itself. It is the combination. E-commerce remains a habit. Cloud computing remains a backbone. Advertising grows naturally wherever attention and purchase intent concentrate. Artificial intelligence may improve product discovery, ad efficiency, and infrastructure demand all at once. A business that can reinforce itself from several directions is much harder to uproot than a business living off a single product cycle. The market may argue about what multiple to pay for that in any given year. I understand that. Markets argue about everything. But the argument over valuation is not the same as the argument over durability. On the durability question, Amazon has built itself into one of the strongest positions in modern commerce. The second kind of forever business usually forms where the customer relationship gets deeper with time instead of weaker. That is what makes a company like SoFi. Interesting. Banking has often been treated as a commodity by people who do not understand customer economics. A checking account looks ordinary. A savings account looks ordinary. A refinancing tool looks ordinary. Credit scoring, investing features, personal loans, mortgages, credit cards, insurance offers, all of it can seem like a pile of services rather than a coherent moat. But if you step back, you see something different. Financial relationships can be extraordinarily sticky when they are built early, delivered conveniently, and expanded across multiple needs. The younger customer does not wake up dreaming about a marble branch office. The younger customer lives on the phone. The younger customer wants speed, clarity, a useful interface, fast approval, easy transfers, integrated products, and a feeling that the institution is helping rather than lecturing. A company that wins that relationship early does not just earn one transaction. It may earn a decade of transactions that changes the economics completely. A customer acquired at the beginning of adult financial life can move from student loan activity to checking, from checking to investing, from investing to credit, from credit to home-related products, and from there into a much broader lifetime relationship. The initial revenue per customer may not look dramatic. The eventual value can be enormous. What matters then is whether management is building a platform or merely chasing volume. The better digital financial companies understand that growth becomes dangerous when every loan has to stay on your own balance sheet at exactly the wrong moment. Prudence matters, asset-light structures matter, distribution matters, risk transfer matters, data matters. The ideal business is not one that simply grabs every possible dollar in the present. It is one that builds trust and expands intelligently while preserving flexibility. If management thinks in decades instead of quarters, the compounding can become very powerful. The public often underestimates how large a small financial platform can become if it keeps winning attention in a generation that is just beginning to accumulate income, assets, and habit. Large banks appear immovable until some smaller institution learns how to deliver convenience, speed, and breadth in a form the incumbent was too comfortable to build. That does not mean the path will be smooth. Finance never is. It means the prize is large enough to matter. Then there is a different sort of forever business, one built not on transactions alone but on human attention itself. Meta is in that category. Most investors can describe Meta in a sentence and still miss the deeper point. They say social media, messaging, digital ads. Those words are correct, but they are not sufficient. The true engine is that billions of people repeatedly use the company's properties to signal identity, maintain relationships, consume information, pass time, compare themselves to others, and discover what they should care about next. Those are not temporary behaviors. They are among the most persistent and emotionally charged behaviors, and once a business becomes part of that loop, the value of scale becomes extraordinary. A network with billions of users does not merely have customers. It has gravity, it attracts creators because the audience is there, it attracts advertisers because the attention is there, it collects data because the interactions are there. It improves recommendations because the data is there. It keeps users engaged because the recommendations get better. That is one of the most formidable self-reinforcing systems in business. The reason I would think hard about such a business for the long run is not that every individual app remains unchanged. In fact, the opposite is true. The strongest evidence often comes from how much the company is willing to change. Features evolve, formats evolve, distribution evolves. What was once static becomes stories. What was once stories becomes short video. What was once one main platform becomes several different surfaces, tied together by the same advertising intelligence and social graph. If the company can keep reconfiguring the product while retaining the user base, it proves something very important. It proves that the moat is not a single feature. It is an adaptive system. That kind of adaptability is what allows a business to survive against people who say the product has peaked. There is another factor I always care about in a long-duration investment. I want management that is both capable and deeply tied to the future of the enterprise. A founder still committed to building for another decade or two can be worth a great deal. Not because founders are infallible, they are not, but because durable companies often need a steward who understands the internal logic of the platform better than outside observers do. When a leader has already navigated several technological transitions and kept the business culturally alive, that matters. Artificial intelligence spending does not frighten me by itself when it sits inside a system that can monetize better recommendations, better ad targeting, better engagement, and greater time spent. Heavy investment can be a burden when the business model is weak. In a strong attention platform, it can become a force multiplier. That is why I would separate temporary expense anxiety from permanent franchise value. Now let me move from digital attention to something people too often dismiss as superficial. Brands are not superficial. A weak brand is superficial. A strong brand is a business asset that changes pricing power, customer loyalty, shelf presence, emotional association, and resilience across generations. That is why Nike matters. A great many apparel companies appear fashionable for a few years and then gradually learn the painful difference between momentum and meaning. The market sees a hot product and assumes a lasting franchise, but products can be copied, styles can be copied, fabrics can be copied, a brand identity tied to aspiration, performance, and status is much harder to copy. Nike has spent decades wiring itself into the symbolism of athletic achievement. The swoosh does not merely sit on fabric. It carries accumulated associations with competition, excellence, celebrity, discipline, youth, and cultural relevance. That accumulation is worth a fortune. The reason most challengers eventually fade is that they confuse early demand with permanent place. They build around one look, one category, one trend, one burst of cultural heat. Then they discover that maintaining relevance requires relentless investment, constant athlete relationships, marketing discipline, product innovation, and a company culture that understands it, is defending a global mental position, not just shipping shoes. Nike understands that a business does not remain relevant for decades by accident. It remains relevant because management treats the brand like a living empire that must be fed continuously. Sponsorships, innovation, design, distribution, storytelling, global visibility, and the emotional association between success and the product all have to be maintained. That costs money. Lesser competitors either cannot spend enough or do not understand why the spending matters until it is too late. What interests me is that the customer base is not confined to one narrow income band or one niche identity. Nike reaches professionals, teenagers, school athletes, casual consumers, and international markets all at once. It can sell to performance buyers and fashion buyers. It can recover from product misses because the brand stands above any individual release. That is the kind of flexibility that gives a company longevity when temporary execution problems push sentiment down. Many investors begin to talk as if the franchise itself has vanished. That is usually when it becomes most important to distinguish between a broken quarter and a broken cultural asset. The former is common, the latter is rare. Beauty gives us another lesson in forever. People often underestimate categories that look small or ordinary until they realize those categories are built on repeated personal ritual. Cosmetics and skincare are not purchased once. They are purchased over and over again. If a company can combine affordability, perceived quality, shelf presence, and brand heat, the repetition becomes extremely valuable. That is why I can understand the appeal of a company like ELF Beauty. Its advantage is not mystery. In fact, it is the opposite. The proposition is clear. Good enough to impress, cheap enough to feel smart, visible enough to be trusted, and contemporary enough to stay culturally alive. That combination opens the door to a very large customer group. You do not need luxury price points to create a strong business if you can become the dependable default for millions of repeat buyers. There is something powerful in being the affordable winner. In many consumer categories, a company can get trapped between premium brands above it and discount irrelevance below it. The better operators avoid that trap by creating value perception that punches above the price point. When consumers begin to believe they are getting style, performance, and credibility for less than they expected to pay, the brand can spread rapidly through retail channels and social conversation. Shelf space tells you something in such businesses. Distribution tells you something. Repeat purchase tells you even more. Once a beauty company reaches critical mass, it can do more than sell its original hero products. It can extend into adjacent categories, acquire other brands, deepen its skincare presence, and use scale in retail relationships to keep itself visible. If management remains disciplined and does not lose the identity that made the brand attractive in the first place, the runway can remain long. The public often makes one of two errors with young consumer businesses. It either dismisses them as fads too early or worships them as inevitabilities too soon. The intelligent position lies somewhere in between. You ask whether the company has crossed the line from novelty into normalized habit. If the answer is yes, and if the brand architecture allows repeat engagement at attractive economics, then you may be looking at something much stronger than a passing craze. The beverage business offers a similar lesson, but with one crucial twist. Habit in beverages can become almost automatic. People do not merely buy a drink. They build it into mornings, workouts, road trips, routines, and identity. When a brand becomes associated with energy, performance, or lifestyle, repeated consumption can become incredibly valuable. That is why Celsius is worth studying. A drink brand matters very little when only a niche community knows it. It matters a great deal when distribution broadens. Convenience stores advertise it, big retailers dedicate space to it, and the consumer begins to expect that it will be there. Critical mass changes everything. Before critical mass, you are hoping. After critical mass, you are managing and extending. That is a different game. The consumer who reaches for the same can again and again is not performing an analysis of discounted cash flow. The consumer is following routine and preference. In that moment, the brand has become part of behavior rather than an object of comparison. If the taste profile works, the branding resonates, and the distribution machine keeps the product in front of the customer, growth can continue for a long time. The really interesting thing happens when a beverage company begins to own more than one viable brand. Then the enterprise is no longer dependent on a single label. It can serve adjacent demographics, occupy more cooler space, negotiate from strength with distributors, and turn category knowledge into a broader platform. That sort of expansion can transform a promising brand owner into a much more durable consumer company. I have always liked businesses where the unit economics can become very attractive. Once volume reaches scale, in drinks, branding, placement, and distribution are everything. Once those pieces are aligned, the customer's repeat behavior can do the heavy lifting. The market will still produce scares, it always does. But if the brand has genuinely entered the consumer's life, time can be a tremendous ally. Now let me turn to a company that many people would overlook if they were thinking only in terms of spreadsheets and not in terms of aspiration. Wynn Resorts is not just about gambling. That statement matters. If it were only about gambling, the moat would be weaker than people assume, because many places allow people to place bets. The real advantage lies in premium experience. People with money do not simply buy access to games. They buy environment, status, service, comfort, exclusivity, food quality, reputation, and the feeling that they are participating in a world designed around them. When a property becomes the preferred destination for that experience, it occupies a powerful place in the luxury ecosystem. That is what makes an exceptional resort hard to replace. Luxury hospitality is one of those businesses where the physical asset and the intangible perception strengthen each other. A beautiful property helps the reputation. The reputation brings affluent guests. Affluent guests attract restaurants, nightlife, events, and social relevance. Social relevance justifies premium pricing. Premium pricing supports reinvestment. Reinvestment preserves the property's superiority. The cycle can be very rewarding when management protects the brand. The easiest mistake is to treat all gaming revenue as if it came from interchangeable boxes. It does not. The customer at the high end cares deeply about how the experience feels. A company that has become synonymous with premium treatment, visual distinction, and elite atmosphere can preserve pricing power longer than a simple market share table would suggest. And here again we find the same principle. The future is not built on one quarter's excitement. It is built on enduring human desire. Wealthy people will continue to seek entertainment, prestige, and places that make them feel they have stepped above the ordinary. That desire is not disappearing. If anything, it tends to strengthen as wealth compounds globally. There is one more category in this discussion that many traditional investors might dismiss too quickly because they are accustomed to older definitions of durable finance. I would not dismiss a company like SoFi for being too modern, any more than I would dismiss Amazon decades ago for building around a shopping behavior that looks smaller than it would later become. The old map of permanence often gets redrawn. The trick is to identify which new institutions are becoming infrastructure for a generation rather than simply grabbing temporary excitement. That same principle helps me think about Meta, and it helps me think about Amazon. It even helps me think about beauty and beverages. The common thread is not industry. The common thread is embeddedness. The business gets stronger because the customer uses it repeatedly, the ecosystem around it thickens, and the alternatives begin to feel less convenient or less emotionally satisfying. That is the real anatomy of a stock you might hold far longer than the crowd imagines. Now, there is another point I do not want to skip, because many people hear a discussion like this and believe the conclusion is that you should never think about valuation, competition, or execution risk. That would be foolish. A great business can still be a poor investment if purchased at a ridiculous price. A strong brand can still be mishandled. A network can still waste capital. A consumer company can still lose discipline. A resort can still overbuild. Forever should never mean blind. What it should mean is that you are looking for a class of businesses where time can heal a lot of temporary pain if the franchise itself remains intact. That is a wonderful thing in investing. If you own a weak business, time exposes you. If you own a strong business, purchased sensibly, time can rescue you from a lot of emotion. That is why the quality of the underlying franchise matters so much. It gives you a margin of psychological safety as well as financial opportunity. When I look across these kinds of companies, I do not see 7 random stocks. I see 7 different expressions of the same essential idea. Amazon stands on convenience, infrastructure, and adjacency. SoFi stands on relationship depth, digital distribution, and lifetime customer economics. Meta stands on attention, network effects, and adaptive product power. Nike stands on branding, aspiration, and global cultural relevance. ELF Beauty stands on affordable quality, repeat ritual, and retail scale. Celsius stands on habit, critical mass, and expanding beverage shelf power. Wynn stands on premium experience and the enduring desire for status and escape. Those are very different businesses on the surface, but each one is trying to secure a lasting place inside behavior that repeats. That is what I would listen for if someone asked me how to identify a stock that could be owned far longer than a normal market cycle. I would not start by asking whether the story is exciting this month. I would ask whether the customer will still be showing up years from now, and whether the reason for showing up gets stronger with scale. I would ask whether the product solves a repeated problem, serves a repeated desire, or reinforces a repeated identity. I would ask whether management is building a system or chasing a moment. I would ask whether the business can extend from one success into adjacent successes without losing its center. I would ask whether competition can copy the product but still fail to copy the position. Those questions are much more useful than trying to predict which ticker will look smart by Friday afternoon. The market spends an enormous amount of time pretending that short-term quotations reveal long-term truth. They do not. They reveal mood, positioning, liquidity, and fear. Long-term truth comes from business quality, customer behavior, capital allocation, and endurance. Endurance is underrated because it is quiet. Everyone notices the company that doubles quickly. Fewer people appreciate the company that quietly deepens its hold on the customer and compounds for 15 years. But that is where a large part of great fortune lives. The investor who wants a forever stock must make peace with something the crowd hates. The crowd hates waiting while a business invests, stumbles, rebuilds, expands, and proves itself again. It wants the reward without the period of doubt. That is not how compounding usually works. Even magnificent enterprises go through stretches where the headline looks messy, the spending looks heavy, the chart looks tired, or the market finds some new obsession elsewhere. Your job is not to avoid all discomfort. Your job is to know the difference between temporary discomfort and permanent impairment. If Amazon is still becoming more central to commerce and infrastructure, temporary discomfort may not matter much. If SoFi is still deepening relationships with younger customers and expanding across financial needs, temporary discomfort may not matter much. If Meta is still holding user attention at astonishing scale while improving monetization, temporary discomfort may not matter much. If Nike is still one of the strongest athletic brands on earth, despite operational missteps, temporary discomfort may not matter much. If ELF Beauty is still winning repeat purchase with compelling value and rising shelf presence, temporary discomfort may not matter much. If Celsius is still becoming a habitual choice with growing distribution and brand density, temporary discomfort may not matter much. If Wynn is still the premium destination for customers who care about prestige and experience, temporary discomfort may not matter much. That is the logic of patient ownership. It does not guarantee success. Nothing does. But it gives you a rational framework for staying in the right arena. One of the great advantages in investing comes from refusing to play games you do not need to play. You do not need to trade every move. You do not need to chase every rotation. You do not need to turn ownership into entertainment. You need to find a few businesses whose economic position can remain meaningful long after the market's current language has changed. That last point is crucial. Language changes fast. Narratives change fast. Technologies change fast. Human behavior changes much more slowly. The companies that align themselves with durable behavior and then build moats around that behavior can keep compounding through multiple eras. That is why I care less about whether a business looks fashionable today than whether it has built something customers will feel the need to return to. A forever stock is not really about it is about reducing the number of times you are forced to be right. If you own fragile businesses, you must constantly predict, constantly react, constantly rescue yourself from error. If you own stronger businesses, bought with discipline, the range of futures in which you can still do well becomes much wider. That is one of the finest gifts a business can give an owner. The world will keep changing. It always does. New interfaces will appear. New financial tools will emerge. New consumer brands will be born. New entertainment venues will compete for attention. Some of today's stars will disappear. Some of today's laggards will surprise everyone. But even as that parade continues, the deeper currents remain recognizable. People will continue to seek convenience, belonging, trust, aspiration, beauty, stimulation, and status. The businesses that organize themselves around those durable demands and do so with scale, intelligence, and discipline are the ones most likely to justify extraordinary patience. That is where I would look, not for certainty, not for perfection, not for a list that sounds impressive at a cocktail party. I would look for recurring human behavior, strong positioning, and management teams building for a horizon longer than the market's attention span. When those pieces come together, you may not merely own a good stock, you may own a business that earns the right to stay with you for a very long time.